What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. After that, we've got our core list of companies, and if you stick with me towards the end of the video, I've got 4 additional trade ideas to share with you, so definitely stay tuned for that. We've also concluded the polls for our 25,000 subscriber mark t-shirts. We'll be ordering 100 shirts of the Catching Falling Knives design. I want to say thank you to everyone who indicated interest, especially the Discord members who helped vote on the design options. We'll be getting out to you guys with an announcement on next steps of how to order shortly. As always, anything else that we are associated with is linked down below in the description, and without further ado, let's jump right into these charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we certainly have a solid-bodied green bar with very minimal lower wick. It's certainly nothing to read into from a serious sell-side perspective, and a candle close at the highs of the weekly range. So from the structural sense, we do give the win to the bulls this time around. From the location perspective, though, we do have a weekly bar-to-bar higher low and a bar-to-bar higher high. That too is also bullish, but if we think about it in the grand scheme of things, all we've really done is close the gap. That was a critical level we discussed last week, and then stop right there. So there's still the possibility that we roll over here for a gap fill reversal. We'll talk more about that scenario as we drill down to the daily time frame in just a moment, but in the grand scheme, if we really think about location here and trend on the weekly time frame, we have a set of highs, we have lower highs, we have lower highs, and we could still very well be putting in a lower set of highs, even if there is some continuation. So keep in mind, to really reverse the weekly trend here, we need highs that are up and over roughly 415 based on a quick eyeball. Now, if we pull back this week, there's still the possibility we form a higher low and start to develop something that looks like this, which would be another promising first step, but the weekly trend will ultimately not change until we get a set of higher highs. So keep that in mind. Let's scrunch up the chart and start to also bring into perspective some pattern. Remember that we are also still well underneath the neckline of the head and shoulders, so that is still in force as a bearish pattern. If we bring out the volume profile as well, something I want you to notice and remember is that we're always talking about the market moving from high volume node to high volume node. We are once again at a high volume node, so are we going to reject here? Are we going to find resistance? Is a reasonable question to be asking. Again, think gap fill reversal here from the weekly time frame. What we didn't do last week, so something that I do want to point out, is that we basically closed, right, this candle right here in this low volume sort of area. And the market did not continue on lower to this high volume node. So that is a slightly bullish indication as well. But in the grand schemes, again, is this going to act as resistance is the pertinent question. If it doesn't and we break out, it would be reasonable to expect, again, that weekly set of lower highs right here around 415, which is also an extremely high volume node, could start to act as the next resistance. So those are the major areas that I'm focusing on here on the weekly time frame. But again, just to sort of give you a simple takeaway, short term, yes, things are starting to improve, but there's still a lot of work to be done before the weekly trend reverses. That's the main takeaway here. Let's go ahead and drill on down to the daily time frame, pop on our levels and our moving averages. The 50 is blue and the 200 is green, and those are both simple moving averages. Let's take a quick look at the weekly expected move. Now, I would point out that the market's been getting the expected move wrong over the past couple of weeks. So the options market is working slightly inefficiently, right? It was sort of expected as we got out of this compression of range here, but the fact that we closed this week outside of the expected move and the prior week in here outside of the expected move would just be an indication, again, that the options market is not running as smoothly as it sometimes does. And the main takeaway from that, and sort of the reason I bring it up, is just to continue to indicate the volatility that we're experiencing. So is this going to be the start of another bear market rally? Let's go ahead and take into account what the top of the weekly expected move is this time around. It's a gap fill up above. It is the resistance trend line. It is a lot of things. So there's a lot of reason to believe that even if we get continuation into this area, we could roll over, okay? So watch out for the top edge of the weekly expected move. That number is 401.39. And this gap, by the way, starts filling if we can take out 395.50. There's some work to be done before we get there, but those are the numbers up ahead. Again, we've closed on the weekly gap fill, which was this area right here, and that was 389.75. So if we get continuation, first target is the bottom of the upcoming gap, 395.50 that we just discussed. If we start to see some pullback early on in the week, the low edge of the expected move is actually filling the gap from the Friday session move higher, right? We gapped up on Friday, up and over the Thursday high at 378.72 and opened the session at 381.34 and basically ran off to the races. That explosive volatility we saw at 10 o'clock, boom, the market really made a powerful move there. We'll be diving into that move as we move through the video, but on any downside, again, that's your target, sort of filling the gap from the Friday gap up, and that would also coincide with the bottom end of the weekly expected move. Let's go ahead and take out the Fibonacci's, because essentially last week we were saying if this was going to be the bottom down here, then where do we have critical resistance? Notice that we are actually up and over your 38.2. That again is a pretty bullish indication, just in the sense that this bear flag is no longer as ideal as it could have been. Now, it's not to say that we can't fall back in and sort of fail that move up and over the 38.2, but again, it's certainly a good first step as of right now. Now, where else would the Fibonacci's say we have critical levels? Again, we're kind of right at the 50% retracement. So again, will it be the weekly gap fill reversal and also rejection of the 50% retrace? And even if we do continue a little bit higher, notice your 68.1 is perfectly coinciding with that gap overhead. The bottom edge of the gap, once again, that number is 395.50. So all of these levels really aren't, just for no reason on the chart in front of us. They all have some pretty serious significance, both from the Fibonacci perspective as well as gaps and levels perspective. So that's what I've got for us here. And again, I would say that based on what we saw on Friday, maybe the first thought should be, okay, we'll watch and see if we get any continuation, but if it starts failing, we want to be very skeptical. And the reason I say that is, we really have thin structure underneath us. If I go on down to a 30-minute time frame here, notice that again, really explosive move on that 9:30 to 10 o'clock, sort of session. And then after that, the market just grinds sideways and spikes into the close. If we fail this kind of consolidation here, I think the market can easily retrace some of this thin structure that was put in right here, which again, we will see as we move through the market profile towards the end of our S&P analysis. So that's what I've got for numbers to be watching for the upcoming week. Let's go ahead and dive into the behind the scenes look with our S&P sectors. What's going on here, and are there signs of improvement? So XLB for materials is going to be up first today. What do we see? Nice rally and follow through on the Friday session, but again, keep in mind that we've fallen off of a cliff. A little bit of a relief rally is sort of expected, and certainly it's not like we're going to be getting a higher high anytime soon, noting that this is kind of the level to be way up there at 88. Doesn't mean that we're sort of in a downtrend permanently. No, we would have to start forming like a higher low and then a new higher high above whatever was prior set. Okay, so that would be the other way we could reverse the trend. I would watch and see what really happens here on the back test of that 80 zone. We discussed that incessantly as it was hovering above, and now that we're below, again, it strikes me as bearish, but remembering that materials are such a lightweight part of the S&P 500, I don't think we should put too much weight into this sort of analysis. So yeah, there could be some upside lift here, and if it rolls over, maybe that's slightly more bearish, but so lightweight, it's not worth spending any more time on. So let's move along to the XLY, which is definitely much heavier in terms of weight and much more important for the overall movement of the S&P 500. What do we see here? Double bottom certainly could be in play, but remember that for that pattern to really trigger, we've got to be up and over the neckline, which is way up above at 157.18. That would also be your higher high, correct? So there's a lot of work to be done before we sort of improve from that perspective, but we are getting out of bear flag consolidation that was forming here. We've also recovered from the 100% retracement and extension, and now we're above that first dead cat bounce there around that 143.14. So to me, some serious signs of improvement here in the XLY. We, of course, just want to see, can we hold up above 143.14? And again, the reason that number is so important is because that was the dead cat bounce high on the 100% retracement. So going forward this week, as long as we're above 143.14, improvement, big improvement in the XLY. Maybe it's the start of a new uptrend here to get us to the neckline, which would be a bullish implication in the short term for the SPY itself. Now, if it rolls over and does something like this, yeah, I would start to say, okay, the SPY is experiencing probably nothing more than a quick bear market rally, right? So that's what I've got in the XLY. What do we see in the XLC for communications? Again, getting back above the 100% retracement and extension, right? So that was that critical level right here around 56.40. So the candle close on Friday strikes me as a decent indication, just like in the XLY. As long as we're kind of above this level right here, the first dead cat bounce high, I would say we're okay. So 55, that's your level that you want to see the XLC remain above. If it starts to fall back down underneath, again, not as promising of an indication. Any higher lows that form above and do something like this, obviously much better for the start of continued reversal in the S&P 500 and some follow-through continuation based on this Friday little breakout that we've seen. XLF, what's happening here? Anything impressive? Absolutely impressive, just in the sense that, again, we're sort of getting out of this consolidation from down here. This bear flag is slowly but surely eroding, if you will. The one concern here is obviously it's not as strong as the XLC or XLY, because here's your 100% retracement, and we've just closed that weekly gap. So is there the possibility for a gap fill reversal and some bearish activity early on in the week? Yes. So this would be a watch early on in the week, specifically Monday and Tuesday. Can we get up and over 32.50? If we can, fantastic. That's a much more bullish implication. Even if this rolls over and holds kind of the highs in here, it does not strike me as bullish as compared to what we just saw in the XLY and the XLC for all the reasons we just discussed from the location perspective, right? Remaining underneath that 32.50. So really keep a close eye on financials. Next up, we've got the XLK, the tech sector, the heaviest weighted sector of them all, perhaps the most important. And this one does look more promising, right? So here's your 100% retracement and extension. We are above the first dead cat bounce high. So to me, again, a sign of pretty good improvement here as long as sort of consolidation holds above. At this point in time, I would just want to see it above this sort of 100% retracement low, right? That would be this move right here. That number is roughly 128.40. As long as consolidation or pullbacks hold that, fantastic. I'm also liking the volume that came in on the Friday session. If we do get continuation, obviously you're looking for the gap to fill and then a higher low pullback to form and then continuation up to these highs. That would put into play a really ugly, but nonetheless a lower low double bottom instead of an equal low or higher low double bottom. Of course, the neckline would still be way up there at 143, but nonetheless, in terms of big, patterns that are unfolding, that would be the context, right? Which of course would be more of a bullish implication for the SPY if it unfolds that way in the first place. If early on in the week we do something like this and then break down underneath our 128.30, 128.40-ish area, obviously strikes me as just another lower high here on our daily time frame. Okay, so be mindful of that. Use this as a very important pivot in the upcoming week. All right, let's move through the rest of these a little bit quicker now that we've covered the heavier weighted ones other than the XLV. We'll spend some time there. XLI breaking out up and out of this consolidation zone right here strikes me as healthy, really lightweight sector. So even if it does continue to rally higher and the rest of these sectors are moving lower, it's not going to save the day, but any upward pressure is still good upward pressure for the S&Ps. So watch for continuation, wants to stay above 87. Next up, we've got the XLRE for real estate. What do we see in this one? Certainly getting out of this balance in here on the Thursday, Friday session, closing the gap and filling or getting into that next gap overhead as well. Higher lows want to hold above 40.27, 40.25, do something like this. That would obviously be bullish implications for the S&Ps, but again, really lightweight sector, perhaps the lightest weight sector, so we're not going to spend too much more time than that. If it rolls over here, bearish, obviously, but again, it's not going to save the day or sink the ship, depending on what the other sectors are doing. XLP, a little bit more important, certainly, and running away like a freight train to the upside here, really much more strong than everything else that we've seen for longer than everything else that we've seen. This did come in and clean up these lows down here, so the bottom is quote unquote healthy in my estimation. Is this just going to run completely into this area here? I would expect a pullback if that were to be the case. Just like we typically expect a pullback off, or a dead cat bounce rather, off the 100% retracement on a down move, we would expect the same on an up move, right? So here's your 100% retracement, something that does this higher low, maybe that sets up for a breakout point, remembering that the XLP is actually a defensive sector by nature. It's still a good thing that this is not leading the charge to the upside. So overall, I'm not concerned with this chart. It looks healthy here. Higher low pullbacks could very well be in store, and just keep more upward pressure on the S&Ps as a whole. Utilities bouncing as well off of its trend line that we've been discussing the past couple of weeks, kind of at that 50% retracement if my eyeballs serve me correct. Again, not overly concerned. Upward pressure is good pressure. If it rolls over here, again, it's such a lightweight sector that that it's not really going to be a bunch of drag based on market cap weight, but in terms of psychological sort of understanding of risk on, risk off, it wouldn't be a great sign to see this blast through and lead the charge to the upside. Really more neutral in here strikes me as a better look for utilities. Next up, the XLV, healthcare, perhaps one that we should spend more time on because it's second heaviest weight by market cap. Here is our sort of box, the monthly balance that we had been discussing in the past. The fact that it broke in and closed two really strong bars on the Thursday and Friday session here over the past week strikes me as a great look. I was really concerned with the upper wick that formed on the first test on the Wednesday session. I really was of the belief that we were going to roll over there, but a lot of those red flags that I had discussed in the Wednesday video have been sort of repaired, if you will, into the end of the week. So again, it doesn't mean we're out of the woods yet from a trend perspective, but the fact that the XLV recaptured the bottom end of this balance without rejecting here strikes me as a really, really solid sign of improvement. So any higher low pullbacks here definitely need, not want, need to hold above 125. Anything that fails 125 now in the XLV would again fall right back into the category of a major red flag for the S&P 500. So watch that as a critical pivot going forward. Next up, last but not least, the XLE energy continuing to deteriorate here, which again is a good thing. Remember that as the price of crude and oil comes down, I guess we'll just take a quick peek at /CL while we're at it. As this comes down, it should alleviate some pressure on the market. Now notice that this is back down underneath this sort of ascending triangle breakout point, right? We did not make the new higher high in here. We're underneath this. We're kind of sitting right at and around the trend line. If this fails, again, that sort of relieves some pressure on the markets from the higher prices that consumers have to pay for energy costs overall, right? So seeing the XLE come in is actually a good thing here. Remember that we never want to see this leading the charge to the upside, especially when we're sort of looking for major market reversal. So this is a decent sign for our S&P 500. Let's take a quick peek at our ratio grid. If you don't know how to set this up, I've got a video for you, top right-hand corner. The top four are our risk on sectors. When these are pointing higher and above their 50 SMAs, that's the gold line, we're kind of in risk on mode. When they're below, obviously not the case. Now, there are some signs of improvement. Look at what's going on in the XLK, right? Remember that we've been talking about this as a descending triangle. It has still failed to break down from that pattern, and the fact that it's perking up and getting some acceptance above that gold line, the 50 SMA, strikes me as an improving look. Obviously, healthcare, really solid look. It's been that way for quite some time. The XLY has finally closed the distance to its downward sloping 50 SMA. Remember, in here, it was much more concerning, but now that we've gone sideways and closed that gap, maybe there's the opportunity to sort of extend back above it now. So we'll keep an eye on that one very closely in the course of the upcoming week. And then financials, a little bit more concerning here in financials, to be quite frank with you. And we did see that on the structural chart as well, right? It was still below that level, but nonetheless, look at this, right? So still underneath, we're still underneath, okay? So it's really got to get back in the box and above the gold line for me to say, okay, now things in the top four quadrants are really showing signs of improvement. So I would say right now we've got 2 of 1. So I would say this is probably the strongest, second strongest, closing the distance, and this one is still looking fairly weak. So not a great implication there. So it's not quite risk on, but you can clearly start to see some signs of improvement is what we're getting at here in our ratio grid. And down at the very bottom, the bottom 4 are the risk off sectors, right? And to see these deteriorate obviously starts to turn off the risk off sort of sentiment, right? So XLP kind of going sideways, right? The XLE really taking a nosedive underneath that golden line there after it's been so strong for quite some time. That is a good look for the S&P 500 finding a bottom. XLRE really just sideways, not aggressively leading the charge to the upside, and utilities once again going sideways here, starting to get tangled up with the golden line. So I'm liking what I'm seeing here, some signs of improvement, but again, we're not quite all the way out of the woods. We're just sort of negating some of the red flags that I had been discussing on the Wednesday video. So that's the ratio grid in a nutshell. Let's take a quick peek at our interest rates. What's going on in the TNX? We did start to print some hammers on the Thursday, Friday session, but we are back down underneath this breakout point right here. As long as we kind of can remain below 3.1, start to hover around that 3.0 sort of area, that's a decent look. Remember that as this moves higher, it's just not great. It's putting downward pressure on the tech sector. So the more stable rates can be and really stop trending higher, the better of an implication that is for the tech sector, which, as we know, is the heaviest weighted sector in the S&P 500. So continue to monitor that. We want to see these stabilize around 3% instead of continue to take off like a rocket ship like they were in this area right here. So right now, decent look, but the hammers, if those highs are breached, maybe it sets off a new leg here. We just want to see it go sideways, okay? If it goes higher, it's a bearish implication. If it goes lower, it's a bullish implication. Let's go ahead and take a quick peek at the VIX now, continuing our behind the scenes look. This, of course, is volatility. Now, one thing I want to remind you of here is that volatility is still very high, and we did not hit that capitulation type bottom by making a VIX read up around that 40 handle. So because of that, this would be one of the things that still falls into the category of, okay, be mindful that this could just be a bear market rally. The market's moving a little bit higher. They're going to yank the rug out again, and boom, the VIX will spike back to the top of this box. Maybe if it's the real deal, it's going to be the capitulation bottom. We'll go to the 40 handle. But as of right now, because this isn't around the 2050 mark, I'm not yet willing to say that we're out of the woods from a volatility perspective either, especially if we take a look at the VVIX. Remember that we had major concerns as this was making this move here. I mean, 103 has acted as such a historic floor, right? If we scrunch this up, even, if I were to grab more time, you could see that off to the left. The fact that no one was hedging in here made it so that as that deterioration happened, right, those big major gap downs that really shook up the market, that's what sent this higher, right? So the fact that this is coming back down underneath 103 continues to sort of indicate that no one's really hedging in the VIX. So if there were to be a rug pull, again, it could be just as nasty as what we saw last time with the major gap downs, right? Just to sort of reiterate what that was, if we go on over to the SPY chart, that's referring to this section right here where it felt like all out free fall. Now, granted, a lot of the damage happened in the overnight sessions and, we weren't there to trade it, but nonetheless, that's the type of indication that the VVIX is giving us. No one's hedging. If they yank the rug out from under us, it could mean a nasty downfall. So when you balance all of the data points, I do think things are starting to improve, but there's still a couple of head scratchers out there that we should be mindful of. Let's go ahead and take a quick peek at our internals, see what those looked like over the course of the week. Again, I've got a video tutorial for you in the top right-hand corner. If you don't know what we're looking at and what any of this means, that video is going to show you how to set it up, how to sort of use this stuff to make better intraday trading decisions. So look at the serious inflows on the Friday session. Although the S&P volume itself, the SPY volume itself, was fairly light, the inflows across the New York Stock Exchange were significant. We're usually looking at 300 million marks as sort of that threshold. We doubled it on the Friday session. Again, these were slight red flags, the divergence on the up days on Wednesday and Thursday. Why were the volume flows negative? But the huge influx on Friday, again, it's going to give me a little bit more confidence to the upside to say, okay, even if this is a bear market rally, we should sort of go with it for a little while because the inflows were so massive. One concern on the right-hand side, the advanced decline line, is the fact that we were over-correlated on the close of Friday. So could there be a little bit of pullback, a little bit of digestion here? Yes, that would be expected and sort of warranted based on the overcorrelation from the Friday session. Reads of this nature up here are simply not sustainable. Usually you've got to come in a little bit, let the market sort of rebalance. Not everything can be up, right? There's usually some rotation going on. Rotation keeps a market alive. Correlation does not, right? That's the rule of thumb. So that's sort of the implication of that. And again, major build here in the cumulative tick on the Friday session. Again, adding some sort of confidence to the fact that, yes, the buying there was pretty solid and significant. The one thing that we can get to now, because I guess it's just the next logical progression, would be the market profile. So once again, I've got another video for you to explain what this is if you're not sure what it is in the first place. But here we go. Here's a concern to the downside. Look at this post of single prints, right? We also technically closed with a really, it's not technically a spike because we have two back-to-back TPOs, M and N period. But for all intents and purposes, if you remove that last futures session, the 415 session, this was a spike. So a couple of things to watch out for. Obviously, the futures market is open now. It's 647. We're getting acceptance within the spike, so above and in this area of thin structure up here. That is a decent implication, usually indicates two-sided trade. If we were to open on Monday above the top of this spike in here, that would mean that the market needs to auction higher to sort of find the next string of sellers who are going to step into the market, right? The natural buying would take over, and the market should move higher if we open above that M and N period high. If we open below, back in this trunk right here, a much more bearish implication, noting that anyone who went out long on the Friday session might start to close and add some selling pressure to the market, and that opens the door to repairing these single prints down underneath from early on the Friday session. And again, that would coincide with moving towards the lower edge of the weekly expected move and closing the gap. Notice that the volume profile here gets really, really thin through that single print section. So to me, if we breach this level right here, let me go ahead and hover the cursor, that's going to be 38.75 in the ES, which is also half back of that day's session and value area low. So a mechanical level. If that breaks, look out below. I do imagine we could retrace some of this thin structure fairly easily. And again, closing that gap would fulfill the low edge of the weekly expected move. So those are all the reference points that I would be watching from the market profile perspective. In terms of where value is, obviously value did shift higher. The point of control shifted higher. So that would be a bullish implication, but please just be mindful of this really poor structure, to be quite frank with you, underneath us that's really evident in this market profile software. So with all of that being said, let's round out the broad market with the Qs and the IWM. So what's going on in the Qs, the NASDAQ here? Taking a closer look, there we go. Sorry for the little lag there. What do we have on the upside? So for expected move, notice that this would actually breach the top, or not really the top, but the resistance trend line. Right, this has really marked off the recent downtrend ever since that first major rip your face off rally. That sort of was the first bear market rally. Right, this was sort of the next one in here, but this has been in place for quite some time. Right, resistance. So because of that, if we were to break here, that would be a major shift in tone in my estimation for the QQQ. So please be mindful of that. If we head towards the top edge of the weekly expected move, it would be a breach of the resistance trend line. The gap to fill overhead, again, is fairly interesting, very nuanced that we've closed right on it on the Friday session. Those numbers are 294.89, fills up towards 299. 299.10. After that, the bottom edge of this balance area is going to be coming into play. Could we do something like this and reject off of it? Absolutely. Remember that these people still could be overhead supply, and if anyone's waiting for a break-even trade, they could start to sell as soon as we start scratching and knocking on that area. Also, keep in mind the 50 SMA blue line will be meeting us there for a super resistance. This is if we get upward continuation in the first place, right? A break of the resistance trend line, fill the gap, so on and so forth. If we roll over here and head towards the bottom end, so we reject at the trend line here, not weak trend line. That was a misspoken word on my part. I don't want to confuse anyone. The trend line, right? If we resist here and roll over, the bottom edge of the expected move, again, is filling the gap and some on this weekly time frame. In the grand scheme of things, to remain bullish, if this pulls back and sort of respects the gap fill and supports off of it, that would be a decent look for a higher low here on the daily time frame, which I also want you to be aware of, right? So that would be okay, I would say, in the QQQ. If we take out the Fibonacci's, just like we did in the SPY from the high down to the low, notice that this has obviously closed much more firmly through the 50% retracement and right at the 61.8. Always keep in mind that as you move through the 61.8, the more candle closes you get above, the more likely it is that you make the 100% round trip and you do not return back down towards the 0%. Obviously, again, pulling back and supporting here at the gap fill would be respecting the 38.2 and keeping the possibility for a higher low to form on the daily alive. So that's what I've got for you in the QQQs. Let's move along and talk about the IWM, Russell 2000, and the small caps. What's going on in small cap land? Certainly some signs of improvement as well, right? Top edge of the weekly expected move right to the bottom of the gap and 50 SMA from here. That is 181.50. That would be moving through the first gap. Again, a very nuanced close on Friday right at the level. Over 175 fills the next gap up towards 177.60. That's our first sort of area overhead. And then the top of the weekly expected move. And to the downside, if we were to roll over here, I didn't mark it off. There's a very slight gap, but for all intents and purposes, this is the level that you got to see hold to remain bullish in the IWM. If we're above 169, higher low pullback, there's the possibility for something like this. If we breach 169, I would expect lower to head back down towards 164.20. Remembering that IWM is used really more of a risk on, risk off proxy. I would want to see this move through the gap or at least form a higher low if we're looking for bullish outcomes in our S&Ps and the QQQs. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every single time a new video comes out. And with that, let's get right into Apple. What do we see on the chart in front of us here? Very similar structure to what we've just discussed in the broad market. Any pullbacks want to fill the gap and support off of it, or at worst case scenario, support at this level right here, which is 137. The gap, by the way, is from 139.70, fills down to 138.54. If we remain in consolidation in the Friday range and get a breakout, technically speaking, the next major area of resistance to recapture is 144.25. There's a slight amount of gap in between here and here, but it's not really worth reading into too much. The main guide and threshold is going to be 144.25. If we break above it, bullish implication, we're back inside of this balance area from in here. We can continue to resume the trend to the upside. If we resist off of it, that would strike me as a much cleaner area for a lower high to be put in, and then continuation to the downside for the bear market to sort of continue. So that's Apple. Next up, we've got Netflix. What's going on in Netflix? This one finally getting out of its own way, remembering that we were watching this area of balance for quite some time. We finally have a break to the upside. Now, have we doubled that range? For all intents and purposes, yes. I mean, it's not technically all the way there, but we've made the move to close this gap and retest the bottom end of this balance. So I would say the breakout trade has really already happened. Now, one interesting thing about Netflix is the fact that this has already formed a higher set of lows in here. So is that a slightly more bullish implication? Yes. And maybe that means we will get a little bit more upward lift to at least try to form an equal high here around 202.25. Again, be mindful that the blue line 50 SMA could be meeting us there for a super resistance early on in the week if we see continuation in the first place. To remain bullish, we've got to see any pullbacks hold 183, the breakout area here, and then reverse for something like this. Higher lows continue to form, right? Otherwise, if 183 breaks, it would be a look above and fail. Technically speaking, we should start to target the bottom end of balance around 165. Next up, we've got Tesla. What's going on with Elon Musk's world? Certainly a better looking double bottom, right? So you get something that looks like this. Be mindful that your neckline is still way up above 780.75, but for all intents and purposes, we are starting to reverse off of this equal set of lows. We do have a breakout area here, and I would also remind you that if we go down to a 30-minute time frame, we got consolidation with no spike in Tesla, whereas this SPY actually spiked above into the close. So this to me is a better setup here if we can open in this area and then break that 738.50. There we go. Wow. At a loss for words. I need to get my glasses. But nonetheless, if we can break that level, that strikes me as a much more bullish trade. Obviously, use this trend line and the flag pattern kind of as your stop loss and see where it goes from there. If it can't do that in the first place and we just roll over here on the open, it's got to hold up above 700. Any failures back down underneath 700 strike me as bearish, and again, continue sort of the trend and idea that we're just putting in a lower high here. So in between this area, kind of neutral, breakouts look decent, and then anything underneath 700 flipping back into the bear category. Next up, we've got AMD, this one poking back into its daily balance. Here it was, right? After a couple of inverted hammers here, which definitely looked to be in the bear camp for lower on the break and retest, this is a little bit confusing, I would say, to trade. I wouldn't say that there's any major, obvious structural setup that's unfolding here inside of AMD. I suppose in the grand scheme of things on like a weekly time frame chart, if you look at this as a range, we had a look above and fail, hit the bottom end of the range. Right now we've had a look below and fail. Let's see if we can hit the top end of the range. But even then, I mean, maybe if you're a swing trader, you place a stop underneath 85 and target 100. We'll see. I would just take this day by day and see if any better structure forms, any intraday setups form. On the daily time frame chart, that's kind of all I could read into it for you. But this kind of strikes me as sloppy. These wicks, this sort of balance we saw in here, I'm not seeing the obvious trade essentially inside of AMD. Next up, we've got Meta. What's going on here? So certainly a reversal off these lows. This was the most bearish of them all, noting that yes, we've made new lower lows from there to there, but this big bearish engulfer was unlike anything else we'd seen through the broad market or even the core list of companies. Then this hammer and follow through on Friday's session has flipped the script. The next bullish trade that I would be watching out for is a filling of the gap overhead and then follow through some of this thin structure to backtest 188.50. That's the upside trade here inside of Meta. Anything that can't really do that, I would expect consolidation here. If it's above 165.60, that's fine. Have a little bit more of a bullish slant. If it breaks underneath 165.60, that's where I would say, okay, in the grand scheme of things, we haven't really made any progress from here to here. We certainly still have a big lower high, and there's the possibility that this is nothing more than bear flag consolidation, right? So 165.60 would be that pivot and kind of line in the sand for me. For bullish, fine over time, and then underneath, much more bearish to just kind of hands off for now inside of Meta. Next up, we've got NVIDIA. What's going on in the chip maker space? Much more different rather than AMD. Notice that if you were to think of this as kind of the range, it's just been playing ping pong inside nicely instead of look above and fail, look below and fail. Nonetheless, a nice strong close above these highs on the Friday session over 169.50, probably better illustrated on the 30-minute time frame. And again, you can see this sort of more closely mirrors the spike that we saw in the SPY. So here you want to make sure that any pullbacks remain above that breakout point, the 169.50. If it fails back down below, that to me would be an implication that, okay, these people are going to be disappointed longs. They might close out if we breach these lows. So this is getting a little bit nuanced here. But if we crack 168, that's where you would start to look through for the retracement through some of that thin structure in here, right? Disappointed longs close out, add to the sell side, and boom, you make the move down lower. Does it form a higher low? Maybe. You'll have to monitor for continuation. Of course, use intraday intuition, but those are sort of the numbers that I would be watching early on the Monday session specifically. To the upside, this gap overhead is going to start to act as your next magnet and target. That's 177, we'll call it for round number's sake, fills up towards 180.32. And to the downside, we talked about this, 159 on the breakdown of 168. Next up, we've got Microsoft. What's Bill Gates have to say about the world recently? Certainly his stock is doing quite nice and getting some serious follow through to the upside. This one looks a little bit more impressive than many other things we've seen so far. Even Apple, notice that this is closed right at the bottom end of the balance in here at 267.25. If we can poke above, or even at this point, I would say in Microsoft, any consolidation that happens above this gap up that was put in on Friday's session, so anything that's above 261.77 strikes me as bull flag, right? If you look at it from this perspective, I mean, geez, in the short term, it'd be hard to argue anything other than a bull flag. But you would, of course, have to be mindful, right? Look at this. There's a bull flag. But if it starts to break down, step aside, right? For all the same reasons we just discussed in the NVIDIA perspective, right? Disappointed longs on the consolidation, then breakdown. All of those people got it wrong. They close out, right? That's what spurs these downside, sell side moves. So be mindful of that. But anything that's above 261.77, decent. Looking for the bull flag to get to that next target here, 273.50. Anything that rolls over, obviously gap fill is your target. That's a trade in and of itself. Under 261.77 fills down towards 259.40. And then the major line in the sand would be here at this point in time, 252.50. Why is that? Here's your big breakdown. There's the first dead cat bounce high. You want to remain above that level, right? So that's 252.50. That's what we've got in Microsoft. Last but not least, the mini beast, Amazon, big double bottom, right? Something that looks like this. Obviously not in play right now, but something to be watching over the course of the upcoming weeks here. Zooming in, what do we have? Again, breakout and follow through on the Friday session. Here's a couple of numbers. Again, probably better to look at on the 30-minute time frame. Everything we just discussed in NVIDIA, same exact idea. Here's your bull pennant. Breakout happens. If we open below 115, you get disappointed longs. We're probably coming in for the back test of this level here around 112. Anything underneath that, you've got 109.06. Probably better to go back to the daily now, and that's coming from your first dead cat bounce lower high, right? So that ultimately is the line in the sand, but this is kind of the downside trade that could start to unfold if we open underneath 115 based on disappointed longs, okay? If we remain above 115, I would look for follow through into this around 120.38. That would be a back test of this first failed bull flag up here, which led to the breakdown, obviously. And again, for all the same reasons we discussed in the Qs and the SPY, you could have overhead supply here who starts selling for break even if they were long, looking for, again, a quick out at zero, which would add selling pressure to the stock. So that's what I've got for you in the core list of companies. Let's get into these ideas. Quick reminder to hit the thumbs up button, the subscribe button, the bell button, all of those buttons YouTube tells us to tell you about. And let's get right into these trade ideas. First one is going to be on ticker OXY. This, of course, is in the energy sector. The energy sector is moving lower and exhibiting relative weakness as we've just outlined. And what we can see in OXY is a bear flag after a 100% retracement from here back down to here. So we have gone sideways through time long enough to sort of merit continuation at this point in time. And on Friday's session, we saw an inverted hammer candle print. So again, relative weakness weakness compared to the market, which was screaming to the upside, right? So if we can put in an equal low reattempt here around 54.40, that opens up the door for this level to break and come into 48.61, the bottom of that breakout candle, okay? So that's what we've got, bearish trade idea inside of Oxy. Next up, we've got ABNB for Airbnb. What's going on inside of this one? You can see that we have a gap to fill overhead. So if this volume was real, if this is the real deal, and this is going to sort of mark a bottom here, so higher set of lows, the first trade is obviously for a quick scalp to fill the gap overhead. That's probably a 5 or 15 minute breakout trade. And then after that, you've got thin structure from the breakdown of this rising wedge, and I would start to look for 122.80. That would be more of a swing trader's perspective. I'm not saying that over the course of one day, we're going to put in a bar that would look something like this. So first thought, look for this gap to fill overhead and then monitor for continuation up towards that area. If we never make it into the gap in the first place, it just continues to build out a bearish balance in this overall area, okay? Next up, we've got Snowflake. What's going on here? Pretty impressive breakout, but we've closed right at the 50 SMA. We know that we're in an overall downtrend. What I'm watching out for in Snowflake is a pullback that then holds 137.50. If we get a pullback that holds 137.50, we form a hammer candle down here, an indecision doji, something that looks like this, that would be a long indication that this is a true breakout. We're forming a higher low, and we can see continuation. Maybe, I use this word very lightly, we get some sort of short squeeze if there's a heavily shorted amount of the stock out there that starts to correct as we break this overall downtrend, okay? So watching this 137.50 area like a hawk on pullbacks, that could be spurred from a move into that 50 SMA, something that does this. That's the look in Snowflake. Next up, we've got TTD. What's going on in this one? Much more similar to Airbnb with the balance area, right? We've got this kind of going on right here. If we can breach that 50.28, remember that we had discussed this bull flag symmetry from in the past, we would be moving back into that consolidation. That's a trade in of itself, so up and over 50.28 for the long into probably the 50 SMA, and then see, okay, if the market's going to remain strong here, if this is truly going to act as some sort of bottom, maybe this is a really large ascending triangle, right? And over time, 55 starts to act as a breakout point to get us to here. Obviously, that's much more of, again, a swing trader's perspective, but in the short term, watching this level like a hawk, 50.28 into the earlier part of this upcoming week. That's all I've got for you on today's session. Thanks for sticking with me. Thanks for tuning in. If you've made it this far, drop me night owl as our keyword down below in the comments section. I appreciate you all being here. Drop the video a thumbs up. We'll be live streaming tomorrow morning at 8:30. And with all of that being said, I wish you a green trading week.